Welcome to the Grey Market Talk with former market maker, retired partner from Best Earns, and portfolio manager, chief investment officer, ex-bond trader extraordinaire, Nic I. Today, we're going to talk about what happened in the first half year and what's going to likely happen in the next 6 months we have in front of us. Nic, thank you very much for taking the time. How are you?
I'm good, very good. Should have been playing golf today, but here we are.
Well, you mentioned that to me, if we would attach golf videos to the end of a video, we would have more viewers and subscribers.
I think that's right.
Maybe we should do a show on the golf course. Hey, you'll never know. So obviously I have lots of questions for you, and we will raise a couple of topics which we've mentioned in the past casually when we were talking about, especially in which quadrant are we in. But I think the best starting point is I'm going to share my internet or the World Wide Web sphere, how was it Gordon Brown called it that years ago, former chancellor.
What did he say?
The World Wide Web sphere.
Oh.
For the internet. And this is the beautiful side from State Street, the sectors. And let's kick into the 6 month, which is exactly the same like year to date. And what are we seeing here in front of us? Nic, should I have been invested at the beginning of the year simply in the S&P? Yeah, do the long term. I just do dollar averaging and I don't care anymore, and I will receive my 7 to, or the last 10 years, 9% annually. Would that have been an appropriate strategy?
For some people, it might have been. I must say, some people can't really focus on inner sectors and things like this. But if you're able to, drilling down into the sectors is much more lucrative.
Absolutely. That's what we're going to do today, because there are a couple of, I want to call it idiosyncrasies, and we'll get to that in a moment into details. Let's first have a look. So obviously the outperformer of the year is technology, right?
Yeah.
Which is very interesting. What do we have here? Let's say index weight. That is what always interests me. Apple, Microsoft, NVDA. So we have 55% or just over 50% of the market concentrated into 3 stocks, which are responsible for the performance. Nic, you're an investment manager. Were you ever allowed to make decisions where you could cluster the risk within one sector in just 3 stocks?
You'll have to be a bit more precise about the question. But, people who want to replicate something like an index, have got to be pretty damn sure that what they're using is going to have a very narrow variation to what the index actually produces. I mean, not a lot of these ETFs don't replicate an index perfectly, and they do that because it's cheaper to just pick a few stocks rather than 50 or 100 stocks. So the smaller the better, the less variation, potentially the better. But just 2 stocks is a bit tight.
Because I'm asking that question a little bit facetious, because I had a couple of nice conversations with discretionary portfolio managers, and obviously they're licking their wounds even if they have positive absolute returns in there. But their feedback was, Thorsten, even if I would have got it right, I would have picked NVIDIA, I would have picked Apple, I would have picked Microsoft, my investment internal policies, they would have come after me with a pitchfork if I said, oh yeah, I've clustered my risk in these 3 stocks. It's like gambling. I've all put on green. I hope I'm in the right sector, and I hope I've picked the right underlyings within that sector. I simply can't do that. Even when I was right and I wasn't NVIDIA long, I had to skim my positions down because the risk became too large. So is that an inherent built-in fault in the system with all Delta One investing? Just, let's buy the index and be happy about it, which is perpetuating this huge upswings we see at the moment in the leading sectors.
Look, I think the whole financial system is, needs to be a little bit more, how should we say, tweaked to reflect what's going on, because all of the money that's going into, let's just say, the US market is flowing into the US market because the US has a large part of the global index. And so it kind of makes sense. And people say, well, you know, that also makes sense the way it is, because, you know, if you want to invest a large amount of money, then it has to go into the large caps. And that also kind of makes a lot of sense. But, you know, what does Apple need with all of this money investment, right? So what are they going to do with all of this cash effectively with their, you know, the stock valuation? You know, what do they do with it? They're going to grow organically, but also they're just going to say, well, look, we've got a ton of cash. Our stock is worth a hell of a lot of money. Let's go and buy some companies. So in the end, what you see is the money that sort of comes into the, you know, the large caps and stuff like this is just a great excuse to go and buy some cheap stocks that don't get the money.
Yeah, but well, in the case of Apple, you seeing me now?
I saw. How clever is that?
That's what Apple is doing with all that money. You heard me being overly excited when I saw their new tool, which I just superimposed thanks to the help of Zoom on my face. I see a point there. Yeah? I had this feeling the last time when, how many years ago, Tesla introduced the Cybertruck. You know it, at the time, I was completely like, wow, I want to have this. That was before the energy crisis, and electricity was still cool, and nobody was suspecting that governments might switch you off if they run out of electricity, and that there might be brownouts on the cards. And I immediately bought an option, which they sold for $100 on the internet. So you had your reservation in. And now we're a couple of years later, and I still haven't seen a Cybertruck being delivered. I wouldn't take up on that option anymore now, by the way. Yeah? But I looked at this, we built up options position, we cashed out with 100% plus, and then the stock made 800% afterwards. Yeah, so we were a bit too early. But I had this feeling, when did we speak about it? 2 weeks ago, 3 weeks ago, when I saw the Apple thingamajigger on the market, where I thought, yeah, that could be actually be a barn burner for them. So I understand it. What is Apple doing with all that money, you asked? Well, they still have debt, don't they?
Because they do have debt, because they're trying to make their capital efficient. You know, what is tax deductible, what is not tax deductible, and I'm sure they, you know, they do this effectively, but they are a solid shop. And at the end of the day, they've got a shed load of cash, and they can put that money into, you know, continued, you know, growth within their company, or they can start to buy things that, you know, with a 3 trillion valuation. Where's this thing going?
Oh, we have.
So I know what I would do at that level. I'd be saying, okay, let's go and find some small companies out there that have already spent the time, ship them in and just say, here's my Apple stock. We saw a lot of that, you and I, you know, in the early 2000s, yeah, when stock prices were where they were. It was very, you didn't see many cash purchases, you saw stock purchases.
So that would mean actually the M&A market would also have to pick up if this is consistent, what we are seeing here at the moment. In theory, exactly. M&A markets, obviously, they love it if there's cheap money and the macro environment is positive. Now we have the situation that we don't have cheap money anymore. And I think we briefly strived that last week when we were talking about liquidity, that there is also how do we call it, a high yield wall coming in within the next 1 or 2 years, when all these companies which are not so Apple have to refinance themselves. So instead of waiting till actually their financing runs out, they will have to start doing it now, sooner or later. Is that an opportunity for the big guys at the block to say, fine, we take on your debt and we share that against your equity, and thank you very much, we're in?
I'm sure it is. I mean, that's probably, you know, very general statement to say what is the great opportunity right now for these people. You know, that's a real big question mark. There for sure are going to be those companies that can't afford, you know, or haven't created enough buffer for the refinancing rate where they are right now. And some of these, you know, growth companies that kind of got away with it with 2% interest rates that have no chance to survive refinancing at 6, 7, 8, 9%, whatever they're going to be charged these days. So I'm sure that's an opportunity for these big companies to come in. But that's they need to have guys that look much deeper into these companies.
Now we have the situation. We have the first $3 trillion company here, and unfortunately I don't have the chance today, but I saw somebody sent them around on LinkedIn. It was the relationship of Microsoft, Apple, or NVDA compared to all DAX 40 stocks in Germany, and you can imagine you could buy 3 times the DAX for what you have in Apple here. Apple has now price earnings forward ratio north of 30. Is that sustainable in a market where everything for me at the moment seems to be priced to perfection? We're expecting that the Fed will lower the rates, even though the Fed says the opposite. Market ignores it. Earnings, yes, but if you're worth 3 trillion already, it's far more difficult to grow at that level than when you're a little shop with just 500 million or billion even in market revenue. So I like the product that's coming out. I was enthusiastic about it. Yes, it's a huge shop. They never have any earnings problems. They buy their own shares back. Warren Buffett loves it. So am I an idiot of being cautious here with Apple, or?
Are you an idiot being cautious with Apple?
Yeah, I wouldn't short them now.
Correct. So you're going to say, well, what's the bloody upside? How long is it going to take before it goes from 3 trillion to 4 trillion? At that level, isn't it getting rather a bit silly? Because these guys will have political clout in America. They won't allow that. What do you do at this level? Right. I mean, that's a real big question mark, what you do at this level, because, you have to ask yourself just how much upside there is in Apple versus some of these other underperforming, if you still like tech, underperforming tech companies. And, I think there was a big spike in things like Unity Media, when Unity Media were kind of involved with these visors, I think, or I think they were somehow involved. So, relationships like this, those are areas of spotlight, I think, for investors to take a look at, to diversify out of, these top companies, because, even though I've been, how should we say, positive, and we own Apple for our investors, by the way, not more than, it's not a large part of the portfolio. We own Apple and Microsoft as part of a quality portfolio. And, it always gets rebalanced. So, it starts with 2.5%, it goes up and goes, and then we rebalance it. So you're taking profits all of the time in this thing. But, what would I do if I had Apple stock right now on its own? I'd be looking for something else.
Probably. If not, the face thingy is coming out and it's going to be the new iPhone. Then you have a $6 trillion.
People sort of do take the mick out of Apple because they say, great, they've got a new phone with a new camera, or it's now a red phone, and where's really the technology in this thing, and how much of what we're seeing in Apple is technology advancement versus how much of what we're seeing in Apple is just sheer flow into equity, into market cap stocks, into ETFs, and when the elastic band stretches too far, you need to look somewhere else.
Yeah, absolutely with you. So fine, we have our techies, 3 companies making over 50% of the holdings in the technology sector. If we are in quad 1, the Goldilocks zone, and I'm going to put a slide up of that in a second, but let's first go into the other unexpected big beneficiary companies sector, the consumer discretionary. Did anybody last year have consumer discretionary on the cards? I cannot remember having spoken to anybody who said, yeah, I have to get me some of those.
Well, if you remember, the world and their wives were forecasting the end of the world as we know it, and selling subscriptions. And so for 6 months, you had these so-called experts saying, there will be a deflation, a depression, look at what's going on. Surely, look at these leading indicators. Surely,
no, I was part of that crowd.
So, but you weren't trying to sell yourself, though. So you had this kind of view from everybody and trying to convince everybody else. So, on that basis, would you expect people to have been invested in consumer discretionary? You'd think the exact opposite. You'd probably expect, and we can look at it later, something like healthcare, nice, innocent, safe kind of stock.
Absolutely.
With your mentality of there's going to be a deflation out there, so I need to pick the safe sectors that will, how should we say, outperform, or they would have been betting on utilities. Also a nice boring stock. We can have a look at that one as well and see how these chaps did.
Would have been the prudent thing to do, yeah. And again, here we have this cluster risk of north of 40% are tied up into Amazon and Tesla. Let's forget Home Depot and McDonald's for a moment. But again, yes, they're performing nicely. They have massively contributed to what we have seen in the first quarter. But it always comes down to positioning. Who was positioned for the market we've seen now for the 6 month or a year earlier? Almost nobody, right?
Fortunately, there are a few who, I've seen who, these unsung heroes who have been, bullish for some time, and also in tech, I must say. So they do deserve a big applause.
Yeah, of course, but you usually do not hear a lot about them.
No, you don't, because they are outnumbered by 10 to 1 of the, or more by the other mob.
Yeah. And now our other to be expected Goldilocks scenario, communication services. Meta, Alphabet, T-Mobile, Verizon. What are we having here? Again, the same clustering. It's Netflix. Almost everything 50% in 3-4 stocks we have seen in here. Yes, there's a reason for it. I listened to a podcast the other day where somebody had an interesting thought. It said, it's always important to what do you not hear to actually notice that. And he came up with this example. I've unfortunately forgotten his name. Otherwise, I would have given the credit for it. He said, a year ago, everybody was talking about the metaverse, how you run around, buy real estate in the metaverse, and how Beyonce already knows owns something, and you could live next to John Wick in a house. And then Apple comes with their face mask, and nobody talks about Meta anymore. Not negative yet. You have the first signs that people say, oh yeah, well, I wonder whether Zuckerberg will actually be able to compete if Apple builds up a competing infrastructure, because it just works beautifully within their whole framework they have. But I thought that was a very interesting thought to say, yes, Meta had a fantastic performance. We've seen it, 138%. Wow. But is the story over? The clustering over? Google marketing dependent, I would simply frame that in. If we don't see a recession and the market keeps on performing, why should you sell Google? There's not actually a point to do that, especially they are still in the AI fold. That could be the next big thing. Meta, big question mark. Again, is the risk to the upside or to the downside in this stock? In my view, would I go Meta long at this level? No. When did I go Meta long? Just when they were below 100. Nobody wanted them. They were like a steel mill going out of business. Everybody already saw Zuckerberg being fired. That's when we exposed ourselves. Of course, we sold too early again. But in a scenario I see at the moment, is there a real point to the upside? Do I have to put my chips on the table to squeeze the last 10% out of Meta? I don't think so, but I might be wrong.
Yes, that's that is a great question. I've just lost you somewhere, but I don't know the answer. I must say, I really don't know the answer. The way that I look at all of these things is that because I don't do the thorough bottom-up analysis, I do the filtering, get some filtering from some of these services, get a short list, and then follow trends. And at the moment, I haven't looked at Amazon, but my guess is the trend model will still be saying stay long. It's like the same thing when you talk to me about NVDA. I just look to the right, put my model up, and it said, stay long. And that's how I would behave with all of these things, rather than try to be too cute and say, well, let's go and sell some Apple now, let's go and sell some of this, or Meta or Amazon or whatever it might well be. Wait until the market tells you, because as you said, you sold too early. Is that a message to say, well, you've got an investment approach which says, well, when I make 20 or 30% on something, I'll let it go? Or do you have something which says, I'll focus on momentum, I'll focus on trend, and only when I get the message from the momentum or trend indicator will I sell? Or would you have a combined approach? I'll sell half when I make 20 or 30, and I'll leave the other half for the trend signal. So that's the way that I would handle such a question, in a sort of an individual stock portfolio.
Haven't we just made on the technical situation, it's called a golden cross, where the 50-day moving average is crossing the 100-day moving average from the downside, and actually the confirmation of momentum in the market in here?
I tend not to focus on golden crosses, and that's why, if I thought they'd work, I'd use them all the time. That's why I spent a year creating this model, to try and add a bit more sophistication to this approach. But some people do follow it, and some people do make it work for themselves. But it's like useful, it's an observation, but it doesn't really give me a signal.
So
when
we're talking about quad one, and that the sectors who should perform actually did perform, let's look for some confirmation bias in here now. What should not perform if we have a Goldilocks scenario? And we have that right in front of us, right? Consumer staples did nothing. If you got your quad right, we would expect consumer staples not to outperform the market, confirmed in here.
Yeah.
Then we have healthcare, the same, minus 2.3%. First 6 months, as to be expected, probably not the sector you want to be invested if your allocation is into Goldilocks quad one scenario. Huh?
Yes, that's right. I mean, obviously, this is a scientific approach. I don't know if you want to sort of now explain what quads are to.
Yeah, I think I should keep on talking. I'm trying to find the right slides. Oh, I think I'm already here. Lovely. So let's see.
It's all about investment process. That's where your quads come in.
Yeah. And maybe we can also do a little bit of a teach-in, because I use that to try to cram 4 years of university, which occasionally seems to be useless, into a 1 or 2 day lecture for my students. And unfortunately, I'm a bit lazy. I'm only teaching German students at the moment. That's why I call it the Wirtschaftszyklus, the business cycle, and the quad model. What are we having here in front of the screen? You can see it, Nick, yeah?
Yes, it's visible.
Yeah. So we have 4 quads in here, and we have an x-axis, which is focusing on, let's call it the price of money. And we have a y-axis here, which focuses on, is stuff being produced, yes or not, and is that growing or not? Nick, I know you are working with a quad metal for I don't know how many decades now. The research for the first iteration of that, if I remember it correctly, is going back to the 60s or 70s when Merrill Lynch did the first work on that, to put it into a statistical framework, to do a proper analysis. But the question I first get asked, and who could be better to answer it than you, is these two axes I have here, the x-axis and the y-axis. What am I actually looking at, Nick, when I'm talking about deflation and inflation?
So, here you've got it in German as well. You've got expansion and contraction on the y-axis, and on the x-axis you've got inflation and deflation. So you've got a situation on the right-hand side where inflation is rising. On the left-hand side, you've got a situation where inflation is falling. On the vertical axis, you want me to carry on? I mean, just describing your little quad model here. On the vertical axis, you have growth. You go back to the thing, and then on the bottom half of the picture, you've got GDP falling. So above, GDP is rising. Below, GDP is falling. To the right, inflation is rising. To the left, inflation is falling. So, and that's where you get your quads, because then you can create a market regime where you say, well, what if there is some growth and inflation is falling? Then you have this quad one, which is what you were talking about, and you know, if maybe I'll just say one or two more words. You know, this is a very useful way of giving you a starting point, an orientation of what you should be looking for. And the idea is that you will try to forecast where you will be, let's just say in the next month or next quarter, so that, you know, you think, well, should I still be invested now, or should I be looking for a point where I'm disinvesting my stuff?
Now, I'm clicking through the right slides here that I get a more comprehensive overview on the screen now. As I said it, I'm using this to explain the basic principles we have here. And you see that again?
Yes.
That's a pretty, let's call it a blunt description of the various points you should have a focus on. And obviously a lot of cycles, credit cycle, PE cycles are not in here, but it gives a rather good explanation. And you went beautifully in and said, okay, what did I mean with quad one? We are here now in this quarter. And Aktien, obviously, are equities, corporate bonds are here as well. The big top level analysis, and then we are going into the sectors in green, which should perform nicely if we are in fact in quad one, where we can see, yes, the economy is still expanding, and we have this, let's call it disinflationary environment. Yeah, we're not in deflation, we're in disinflation. Inflation is coming down, makes money cheaper again. And as to be expected, as the statistical data did show us, and I have a couple of slides on that as well in here. Yes, we have seen tech is running, we have seen discretionary running. And now it's the question, industrials, they did okay, and materials. And materials is one of these sectors. Shouldn't that also be one of the performing assets? And when I go back to the other screen, sorry, I'm jumping a little bit. I should get better with that. Shouldn't materials also give us an indication that we actually are a little bit better, because year-on-year basis, we're pretty much unchanged, plus 2%. Wouldn't we expect that also to pick up, to confirm what we are seeing with these sectors we just described in epic length, that is confirming within this quad one? We should see, first of all, yes, industrials perform well, materials better. Then we should see real estate actually also be right there, with showing first signs of life, and we haven't seen that at all. So how I always make it is, if you have an equation and you have X, you can solve for Y. And now we're doing it the other way around. We have the performances we see in front of us and say, okay, this is Y, let's solve for X. If I look at the performances, shouldn't that clearly point to quad one? And the picture is not that clear, actually. Do you have an explanation for that, or I'm getting it all wrong again?
So, you know, the way that I would look at this, and again, there are some good services out there that do the job. And what they do is they say, well, okay, let's have a look at what the kind of the bottom up is telling us. So let's just say bottom up means I look at the sectors, and I look at which sectors are working and which sectors are not working. And then from that information, theoretically, I should be able to tell you where we are in the quad model, right?
Yep.
So that's your bottom-up approach. A top-down approach might be something where you say, I'm looking at the economic data. The economic data is saying to me, we've got leading indicators down, we've got this, we've got that. And from my top-down model, economic model, my model is telling me that we should be in another quadrant. So I have to sort of, you know, deal with that, firstly, that difference. And second, when let's go back to the bottom-up approach where you say, okay, let's just say that the majority of the bottom-up sector analysis is telling us that we are in a quad one for the sake of argument. But not every sector is working as you've just described. And what I said in one of the earlier videos is, well, this is where you would combine analysis. And it's important that you say, okay, am I going to treat this quad as a gospel and a rule book that I follow? And if I follow this model, I can do no wrong. I mean, I think the answer to that is if you follow the model on its own, you will get caught out, because there is always other factors that, that are at play. And when you look back at the history of what has performed well in this sector and in this regime, quad, and what hasn't performed, you'll also see a spread between what's been the return on real estate. It's been, let's just say, the history over the last 30 years has been, and I'm making this up now, -2% and +10%. And that range is because there's never, ever just, you cannot talk about the actual market in such simplicity, because the market is, of course, far more complex, a beast. And that's where we might be in a quad one, both on a bottom up and top down basis, let's just say, but there might be one or two sectors that are suffering because there are some idiosyncratic reasons, for this. So, for example, we know that some of the regional banks have been having a bit of a tough time. Therefore, the real estate market has been having a bit of a tough time. And so you might say, well, I could explain away part of what's going on in the banks and the real estate just by some of these, special factors that are at play today.
Well, you're implying to the C-scores here anyway. I have a slide on that as well. I don't want to make it too technical today, but this is exactly the variation around the mean we see in different sectors. These preferred sectors, let's call them that, or sectors we are not in favor for at the moment, could evolve over time. I put up a slide while you were talking because I came across that when I was preparing for this talk. That was in the third quarter last year. And the basic assumption here was it's pretty compiled data. All these guys out there offering advice and services pretty much came up with the idea, okay, there are two ways we can go from now on. We can either go into the Goldilocks scenario, which is represented by the light blue scenario, which it seems we have actually achieved, or we can go into the recessionary scenario, which the yield curve pretty much indicated that we would end up there. And completely blunt, if I would have simply gone in my playbook by the third quarter of last year and said, okay, what's inflation doing? Inflation is coming down. Good, 1 point on the axis. What are earnings doing? What is growth doing? Growth is stable. We are no way confirmed in a recession. I would have simply done what the data would have told me on this very, very crude top level with only 2 data points. I would have been invested in the Goldilocks.
So, you're absolutely right, and well done you for interpreting, because at the end of the day, it's now about interpreting. And as you rightly said, you could have been in Goldilocks, those 2 arrows could have been Goldilocks, could have been in deflation. And the investment strategy would have been exactly the opposite, depending on one or the other. You chose wisely, as they said in the film. And well done. But there are some people who, have tried to be a bit clever and say, well, actually, you know what? The analysis that I've got is leading indicators. It's, there's a little bit of a kick in the thing for employment. So I think the whole thing falls apart and I think we're in a deflation. And it comes back down to, when do you get that confirmation? Well, what would you expect to see in a deflation? So let's just say you didn't choose as wisely as you might have done. And you decided, look, we're in a recession scenario and deflation scenario, and all hell is going to break loose. What would you have expected to see? And you would have expected to see the dollar rising. You would have expected to see interest rates falling. Yeah, you would have expected to see gold. Well, gold was going up, so that would have been a plus thing. And you would have also expected to see risk assets fall out of bed. Well, from October last year, you actually saw risk assets sort of find a bottom. You saw gold going up, okay, but you didn't get any information on that. But you saw, treasuries getting kicked. You saw the dollar getting, starting to peak at that point. So all of those things which you would have looked for the kind of the personality of that regime would have said to you, I need to have another look. I think I need to choose again. And that's important. I know you're going to do something now, but I'm going to say one more line. And that is, it's also not so black and white, right? So you've tried to look forward in, you're coming up to Q4 and 2022, and you say, okay, where are we going to be? Well, it's not simply a case of I go left or I go right. There is also that point where how deep to the left do I think this thing is going to go, or how deep to the right do I think this is going to go? Because it may well be, even if I am expecting potentially a narrow recession, and maybe that means technically we're in a quad 4. If you look at the kind of the history of narrow quad 4, or in other words, minor recession, let's just say, you will see that actually the investment playbook would also be totally different to what would be a deep quad 4.
There's one question, Jeffrey Gundlach mentioned that in an interview once, and I couldn't find the study actually. He mentioned a controversial study which said, okay, you can do forecasting. In which quad are we going to be? You forecast all the figures, and the historical study he mentioned, which I could not find, but I would love to get into my hands, said, even if you have a perfect foresight, 100% what's going to happen in the next quarter, and you pre-position already yourself, your performance would have been better by simply doing where we are now in the cycle with the asset allocation. I found that actually mind-boggling to say, fine, maybe we are overcomplicating things too much by having these forecast scenarios, looking at this, that, and the other, instead of saying, fine, there's enough time to actually switch my positioning, move my sectors around. The moment I see the yield curve getting steeper again, we have this huge inversion which we're going to reserve. There's a signal for you. Earnings coming down. Wow, now I want to get out of all these beautiful Goldilocks scenarios and get my portfolio watertight with healthcare, utilities, and you name it.
Yeah, that's, as you say, that's an interesting kind of study thing. Don't know is the answer to that, because I hadn't heard that before. But, I think where a number of people have come a cropper is part of it. I mean, they will know themselves now where they came a cropper. But my guess is that they had put too much weight on certain bits of data that they were seeing. So, for example, leading indicators is like a manufacturing thing, but the economy has kind of moved into services. So if you were focusing on the left all the time, you'd have been saying, oh my God, it doesn't look good over there. But actually on the right, things are not so bad. But I'm not really worried about that, because I think that's going to fall apart soon as well, because if the left falls apart, the right falls apart. And it's really down to interpretation. It is, people do try to be too scientific, but at the end of the day, you need a confirmation. And what I, in addition, use as confirmation is my technical signal. So I actually say, what am I expecting? Do I see that in my charts? Do I see that in trend analysis? Do I see that in my elliott wave analysis? Yes or no? And if I don't, then I have another look and say, well, what am I missing?
Yeah, no, fair enough with you, because the chart I just built up here, by the way, fantastic website. The possibilities you can play around are fantastic. It's exactly confirming what we just discussed. You see the underperforming sectors, you see the outperforming sectors here. We are clearly in a quad 1 scenario since the beginning of the year, right in front of our faces. The question is, again, the positioning. If people are positioning themselves now that we might continue this trend, your indicators are not telling you, let's say, warning signs flagging. We are still on okay, it might continue until I get disproven scenario. Do I get you right there?
So kind of half, as it were. So liquidity is slightly lower at the moment, and that could well be because of this dancing around with the Fed balance sheet, the Treasury balance sheet, or Treasury account, the TGA account. So the US side, there is, how should we say, a tightening of liquidity. Banks are restricting lending, at least they're not expanding their lending. But on a global basis, global liquidity seems to be compensating. So the Chinese have pumped an incredible amount of liquidity in the last few weeks. So there is some compensation. But when the thing that does worry me is not something that where I see an indicator. I saw the ECB kind of show in Portugal this week, where the three central bank governors from the West, plus Ueda from Japan, basically talk about their strategy. And I must say, listening to them, you can't help but have fear that these guys will cock it up. And there is that fear at the back of my mind that, I'm afraid to say that they are totally missing the story of inflation. And I won't harp on about it because I've done it enough in these videos. Yeah. But you do just get the fear that these guys have just turned the screw just a bit too tight. And then they'll look at each other and say, well, we didn't know what was happening again. And the rest of the world pay for it all. So there is some concern from my side that central bankers still don't get it. Yeah.
No, I'm with you on that. And who would actually make you believe that central bankers who are proven wrong over and over and over and over again, this time it would be different. They get it right. That is always because this scenario, I barely hear at the moment, oh no, this time it's different. It's this, we are in the world we're living in, and the Fed is operating at a level where they say, yeah, we're going to increase interest rates. There's a necessity. The equity market is completely ignoring it. In Germany, we have new all-time highs in the DAX, while the market is officially in a recession in there. And that is the scenario I get most confronted with at the moment. Yes, something is going to break, and eventually they will get it broken without any doubt. It's going to happen because they're also lulled into this false sense of security. Yes, employment market is high. And if you look at the historic data, inversion of yield curve, one of my topics, sometimes we have 2 years time until it finally hits the employment market. So within that cycle, we're in now 12 months. And what reminds me at the moment, if you follow the financial press, it sounds a bit like oil is running out in the 70s. And then 10 years later, we say it's running out in the 80s. And then they say it's running out in the 90s. And then we say we're running out in 10 years' time. And the recession forecast at the moment, it could be by the end of 22. Yeah, first quarter of 23, second quarter of 23. Now we're out to first quarter of 24. In this whole scenario. So they're just playing this curve and say, okay, bloody hell, historically, we had 24-month time. Maybe we're at the top end of this line. At the same time, you hear, oh, yeah, if the S&P did 15% in the first 6 months, there's a 9 out of 10 chance that we will end up another 5 to 7% higher by the end of the year.
So the other thing that scares me is that I don't watch CNBC, right? I don't watch the telly. I love it. I know you do. But
how would you get your daily dose of Jim Cramer?
I think I was trying to go for a golf video this morning and I clicked a button accidentally and it was CNBC. What a mistake. And it was from Friday or Thursday of last week, and it was a short interview. And both analysts there were saying, oh, yeah, of course you need equities in your portfolio. And I'm pretty damn sure that if they'd interviewed these people 3 months ago, they would have said the kind of exact opposite, that, the economy and all of this stuff. So what does worry me is that there is a a shift in sentiment from the press, the likes of the CNBCs of this world. And Elliott Wave calls it like a point of recognition, which means it's kind of halfway when everyone realizes they were wrong that way. Now they go this way, and so you see period where there is further rally, but definitely there is a change in the mood out there. People have capitulated, and people are starting to get bullish.
Well, that's the interesting thing. We spoke about that. Well, just timing, praising myself a little bit when I put on the straddle on the S&P. Low volatility environment, vols of 13. And so I said I couldn't know whether we're going up or down. It's bringing in nice money at the moment. I'm more considered now, where do I start hedging on the upside? Yeah, when do I start taking my delta off the table and get neutral again to eventually benefit from the other side? And one of the points is I want to run that by you as well, because if I have you on the line, like I do now for every week, riddle me this. we're talking about a recession is still further down the line, yeah? And the yield curve begs to differ. It's about time. We should see that now. I have here two sectors on which actually should show a better performance right here. Yeah? We have the energy sector, not looking well into a soft landing or in a recovery. We have financials that should do better than they're actually doing at the moment. And we have mentioned that before, the materials right here. These are all factors for me which make me extreme aware of the fact that something might still be brewing, that all the pundits I just mentioned, who are shifting their recession target further out and further out, might still end up right, because the data here, which is important for the real economy, is not really confirming what the equity boys are playing at the moment.
Sure. No, I hear you. And so I may not be able to comment on the screen, but I'd say, what I'm looking at right now is, one of the things I look at is RRG charts, so these relative rotation graphs. And if you look at that for the sectors, industrials don't look so bad. Financials are starting to make a recovery, but I wouldn't touch financials just because what's going on with financials from the macro backdrop, I'm still a bit concerned. Technically, they look okay on my charts. Technically, on the RRG, they look okay. But you hear the US is looking to impose higher capital requirements on these financials. And still, we don't know how much of the business model is going to be eaten up by central bank digital currency, and alternatively, or in addition, DeFi. So question mark on financials. But if you look at, as I say, RRG, industrials look okay, and small caps are making a recovery. And for me, what you were saying, you want to see things that should do well. That's exactly right. I want to see these things that do well, but I'm at the moment looking at industrials, and I'm at the moment looking at small caps, and those will be my measurements, and they both look okay right now. But believe me, I'm sort of watching them like a hawk.
Yeah, no, I'm with you on that. For our viewers, for our listeners, I've just put another chart on the screen with the so-called Z-scores, by sectors, and I superimpose simply a nice line for the business cycle on top of it, and where we allegedly are now in the recovery, or im Aufschwung auf Deutsch, or in the Goldilocks scenario. What do these bars actually mean? They simply mean the variation around a mean which was to be observed in the past. So you can do better and you can do worse. That's what you just mentioned. There is a variation in the data, and there's a variation in the sector performances we see here. So again, the question to the portfolio manager: if I set up a portfolio which is pretty much focused into the sectors which should perform, yes, there will be a couple of lame ducks in there, but I will get overcompensated for the well-performing stocks in there. The time you are going to switch the sector, assuming we're not going into a boom cycle now, which would be the next, we're staying in the Goldilocks, or we're falling back into a recession scenario. Your favorite indicators to, obviously you said your technical analysis, what do your charts tell you where we are here? If I would ask you, give me the three main indicators you're looking for that there's a shift in the mindset in the sector. What are the most important points for you want to see on your screen or in your data?
When you say economic data or
whatever you please. If it's coffee leaves in the morning and that is reliable,
leaves in the morning,
I'm learning every day new things, so I'll take that as well if it works.
I know these things are quite slow, but confirmation of problems in the economy. The areas that I would look at are credit spreads. I don't see any sort of problems in credit spreads, unemployment, so coincident indicators. And, whilst unemployment is or could be rising in a small way, it's not rising enough to actually kind of raise enough eyebrows for me to say that's a problem. So a combination of leading and coincident indicators, when leading is below the zero line, coincident indicator has to be sort of stay above a certain line, which I've got on my with the Fred analysis, and that's not sort of ticking over yet. So what are the other things? The other things that cause problems are property. So I know that commercial real estate is a small part of the property sector. Right now it could well get managed. Yeah. So, but again, this is something we have to see. Is this going to be something isolated? It looks as though property still is okay. And for that reason, simplify the economy. Whilst there's no smoke over there, and there might be a little bit of smoke, but it's no fire, certainly, then I kind of say, okay, now focus on my charts. I keep looking over there and say, is there any smoke? No. Okay, focus on the charts.
You mentioned one point I have obviously in living memory, because I was working at the time in London at Bear Stearns, and the credit spreads started it all. First slowly and then very, very suddenly as an indicator for the market. At the moment, if I take the HIG as a proxy, nothing to see here. Yeah? We move along.
Yeah, I mean, it's interesting, but the HYG or the JNK ETF are both influenced by where the treasury is. Yeah, because it's an absolute value. So what I look at is the high yield OAS for Europe and the high yield OAS for the US, and both of them are trading around, sort of quoted around sort of the 420, 430 level, 415 level, something like that. We even tightened on Friday. They're in a range, they've been in a range between 400 and 500 thereabouts. And it basically says, for now, nothing to see here. But of course, you get these headlines of huge amounts of bankruptcies, and bankruptcies are elevating. So if that is something that is going to become systemic, then I'm hoping that, by just simply looking at these OAS spreads, you will start to see something. I doubt very much, I hope not, that you start 415 spread one day and then it's 620 the next day, because then we're totally buggered. But that's the important thing. Sorry.
No, absolutely with you. No, I'm just trying, obviously, to reflect the experience. We call it the gray market talk about the stuff we've seen in the past, and obviously the future is not exactly repeating what we've seen before. But for me now, having seen a lot of things in this screen, there are a lot of eerie, how would you call it, spooky happenstances, which remind me of things I've seen in the past, not at the same time, but at different points in time. We've seen the dot-com bubble, we have seen LTCM, we've seen the Russia crisis, then we've seen credit spreads exploding before 2008 even. And at the moment, it's almost like the sharks are circling. There is some blood in the water.
Right. I mean, so what was the thing that people really haven't seen? And that's sort of a series of rate hikes. And the last series of rate hikes was, I think, Greenspan, between, 2003 to 2006, maybe 2004 to 2006. I remember interest rate went to 5.25%.
Yep.
And then it kind of paused there. Until you had, the global financial crisis, but people haven't really seen, the kind of interest rate rises, massive interest rate rises, kind of in unison, UK, US, Europe, and for the wrong reasons, right? So this is, they really haven't seen, and so we are in a very, very difficult environment, especially given where the level of sovereign debt is sitting right now, which we weren't at in 2004, 5, and 6, or have been before. So it is a very, very shaky market, put it this way. It's you've got to have your wits around you.
The very bold conclusion for me for today then would simply be, yes, we've raised all the topics. We didn't expose ourselves too much about it and say, okay, fine, until we see reliable data coming in down the lines we discussed, we assume that we're going in the direction which is even statistically more significant, where we're already going. So no reason to worry. The only point where I mentioned that also a couple of weeks ago, I always do my volatility analysis, and sometimes the simple counting. My traffic light system is screeching hot red right now. A situation like this we haven't seen in a long time.
I know, and I think you said it on the first video. You don't get a stock market rally, with the VIX below whatever it was.
Yeah.
And well, obviously we did, and just a little bit. And these, I've tried to distinguish between observations and signals. So things that actually trigger a change in investment philosophy versus, shit, look at NVIDIA's at 40 times sales. Oh God, look at this leading indicator. Oh God, the yield curve. And these are states of the market, but then they don't tell you anything about what to do tomorrow or next week. They might tell you, they might be right for 3 months down the road, like NVIDIA. They're going to say, are you crazy? What did you do? You bought 400? Are you mad? But today, it's just the way the market is. Yeah.
No, it's actually what I want to discuss you at a future point, because as a chief investment officer, there are a lot of mechanics in the market. We discussed that, several times already. What are the driving points for the boys on Wall Street when you make the large asset allocation decisions? Which processes is running through? We've already picked on the data you're looking on today, obviously. But one of the trades a while ago, I wrote an article about, more from the trading side. I called it the 1-2 punch. Did you read it by any chance?
Guilty.
It's one of my favorite trades as a market maker. Obviously, I'm not a day trader, and
don't read it afterwards, promise.
Market direction for me as a market maker was always redundant, because if people are bullish, I sell calls, and people are bearish, I sell puts. So I'm always on the wrong side. So I just have to manage my risk. However, one of the trades I learned out of experience was the 1-2 punch, and that was deeply rooted, obviously, in your profession. You see a stock losing 40% overnight, some horrible data coming in, and the natural reflex of everybody's, oh, that was a fantastic stock, I have to buy the dip now. You know how I always made money out of these trades? I even put the statistics into this article you'll find on Macro Hive, by the way, with Bilal. You go short on the closing the next day. On the closing, the day the stock makes minus 40%, then you pinch your eyes closed, and in 9 out of 10 cases, you will have made money the next day as well. And the question my student said, why? What's the mechanics behind it? I said, think about it. They're large corporations. Let's pick a random company, IBM. They love IBM. IBM has done a fantastic job. Then they come up with horrible earnings. The market reacts immediately. Eugene Pharma, we have all information priced in, stock drops 40%. So what's happening on your side of the business, Nick? You get a phone call by one of your assistants who says, Nick, have you seen that? And your answer will be, well, I've seen it now. What's the decision-making process? My explanation was very easy. Until you get all these guys assembled, the professional analyst who's looking into IBM, who's looking into the figures, who might have spoken to the investor relations department, then they come up with a decision. There's a time delay in there, 1 or 2 days. So when the big boys come out, they don't care. If their opinion has changed on the stock because the fundamental data has changed, they sell it even after it lost 40%. And that is the kind of trade on the short term I always like to see. And that is what I think we should, in a further talk, go into more detail. How is the decision-making process on the Wall Street side of business, where the big money is spent by the big investors? How does that actually facilitate through the markets? That might give us and my students an idea when to do what and what to expect what the big boys are doing. Because, hey, we want to do what the big boys are doing. I just want to do it first. Then I'll make money.
I don't think they're that slow, though. It's my only comment. But the 2 days thing, I think everything else is probably right. But the 2 days thing is probably a bit too...
Well, on my personal experience, which is a while ago since I was sitting myself in the screens doing markets, but I'm not mentioning any names of the German funds. That was pretty much it. Something happened, and then they first had to assemble their, I call them the Avengers, and look into stuff. And nobody wanted to expose till you had the one brave man or woman who said, no, let's sell this shit, or let's buy now. We're talking about selling now. It took a while. So your take is it's faster today, yeah?
Absolutely. I don't need to go into these sort of discussions really, but when we had an issue or something that we needed to discuss, you pick up the phone, you've got 5 people in your room, and in the next, before 5 minutes is over.
All
and
right.
you know, half an hour discussion max, and then you know what you're doing. So
yeah, but you're now playing in the Premier League. I don't know whether the Toronto Pensioners are operating down these lines.
Yeah, that's true. That is true, because they do have to discuss with trustees and and stuff like that. Yeah, that's for sure. It's probably not Wall Street then. It's it's the real money that is the slow guys. Yeah, for sure.
No, let's do that, Nic. That would be, I think, extremely helpful. I enjoy getting this insight from your side of the trading desk, because you were always the guys who called me and made me feel uncomfortable with your orders. So understanding more of this process will help. Nic, thank you very much for your time. It was an awesome talk again. I apologize again that my slides were in German. I will sooner or later update them into English and get the data in there. Maybe that's also something. Our deep dive went down very well, where we could do eventually in the future a deep dive on the quad model, on the sector rotation, everything to, well, fill people in how Wall Street used to work and what they relied on.
Sure.
And in this case, I say thank you again. Any last word? Oh yeah, no, before I ask you for any last words, subscribe, like, and share. You like
subscribe, like, and
liquidity.
Share.
Yeah, that was really, really good. I learned a lot. My students learned a lot, and everybody who saw it and gave me feedback liked it. So shared with people. And I think this one was also quite nice to get an idea what is going on. So now I've done my duty on that. Nic, last words.
There was one question I remember from a couple of weeks back, and I do apologize for not dealing with it at the time. And it was something about mega trends and stuff like this. And should they buy a BlackRock mega trend fund? Just 2 words on that. Mega trends are damned important as part of an investment process. The problem with these mega trend funds that you see, and it may well be different with BlackRock, so I can't slag them off. They're a proper firm, but they tend to dilute their megatrend ideas with too many stocks, and in the end you get a performance which is no different or not even as good as, let's just say, a global equity fund. So be careful with these sort of themed funds. Then you have to really choose your fund manager. That's it.
That's something we can also discuss because Markowitz died last week. Yes. When does diversification stop to make sense? And I think what you talked about, or what you said about the megatrends, is actually one of these points where we can have a look into it. Nic, thank you very much. Thank you for all the questions. You see, we answer the questions as we can. And the liquidity deep dive was obviously a request by viewers. If you have requests, put it in the marks or jump at us on LinkedIn. We're both there. I say thank you very much, and hopefully see you again next week on Sunday. Nic, thank you and goodbye.
See you, Torsten. See you, everyone. Bye-bye.